I'm Charlotte McLeod with investingnews.com, and here today with me is Jordan Roy-Byrne. He's a chartered market technician and master of financial technical analysis, and he's also the editor and publisher of the Daily Gold. Thank you so much for being here. Great to have you.
Charlotte, thank you so much for having me. It's my pleasure to be here.
Really good to be catching up with you. I think it's probably the perfect time because you've just released your book, which is called Gold and Silver, The Greatest Bull Market Has Begun. So we're going to make that the focus of our conversation today, some of the topics that you went over in the book. So I thought we could start a little bit with the basics. You talk about in the introduction how gold has broken out of this 13-year cup and handle pattern. So I thought we could go back and look at how that developed when the breakout came about and why that's important.
So the major breakout that transpired, of course, last year, March of 2024. You had this pattern developing for several years, and I started writing the book about 2 or 3 years ago. And some things have changed. Specifically the secular bear market in bonds, like that became really obvious in the past few years. So that's been a big driver for gold. Similarly, it also happened in the mid 1960s when, as we were talking, the gold stocks had this huge breakout in 1965. And gold, that's important because gold stocks functioned as gold then. So that's kind of the history, the historical comparison for this breakout in gold. But it's significant because anytime you get a breakout from a really long pattern like that, that sets the stage for, depending on the asset class, but usually really strong performance for the next 10 years. Sometimes with respect to gold, the gold market, it can be a little shorter because you get these huge, sharp moves after the breakout. When you're looking at a stock market, for example, the S&P broke out from a 13-year base from 2000 to 2013. And what have we seen? A really strong move for 11 plus years there. Of course, the stock market had the big breakout in 1982. The Dow broke out from a 16-year pattern. Another example, the stock market broke out. It did have a somewhat similar cup and handle from about 1937 to 1950. And in 1950 to 57 was maybe the strongest 7-year period in history for the stock market. So when you break out from a long base like that, it's a really important thing because it's really a secular move where it sets the table for a market that's going to outperform for at least a decade moving forward. So that's the significance of that breakout in gold. And I mean, it happened at the same time as the S&P, which is still rising. And so the secular bull market, the S&P, is ongoing. I mean, maybe it's ending now as we're speaking. I mean, we won't know for a while. But, in the book, I kind of wanted to put all these things in their proper context because the way things are setting up is very similar to the mid 60s, the late 60s, and that period, of course, of the late 60s and the 70s. Like we're setting up for a period that's very similar to that. And much less so to the 2000s or the 1930s.
Yeah, I think maybe let's talk a little bit more about the similarities you see between now and the 1960s, because I hear a lot of different comparisons about the time we're in now versus times in the past. So what are you seeing that's lining up?
Well, a big comparison and a big similarity is if you look at the 100-year period from 1920 to 2020, there was only one secular bear market in bonds, so only one period where long-term yields were rising. That was about 1965 to 1982, or maybe you could say early 1960s to 1982. So again, that's a 100-year period where only 17 or 20 years in that period, again, early to mid-60s in 1982, that's the only time bonds were in a secular bear. And, based on the work that I've looked at in the book and various moving averages, after COVID, when yields went down to, nearly zero, of course, we had the big sell-off a couple of years ago in bonds. That has confirmed that bonds are in a new secular bear market. So again, the only other period we can compare to that is the mid 1960s. So that's one comparison. Then when you look at, well, gold's been going up, but the stock market is going, usually they're not going up at the same time in a big picture. When you look at the 1960s, you couldn't buy gold, but so gold stocks basically functioned as gold then. So, again, you had gold stocks were moving up at the same time as the stock market. They were making higher highs. They were both in secular bulls, which is really, really unusual. Again, the only other time that happened was the mid to late 1960s. And so also in the mid to late 1960s, the S&P was, I mean, you had a breakout in inflation, I think in 1965. So the stock market in the mid 1960s, it really started to slow down. It was, getting towards the end of its secular bull. And so looking at where we are now, the secular bull started in 2009 for the stock market. And, it's getting, whether it ended a month ago or it ends in a few years, that's getting really close to its end. And, as I said, the huge breakout in gold of the cup and handle pattern, that's best explained by gold stocks in the mid 60s, which again functioned as gold. They broke out of a 28-year base in 1965. So all these things, you look at all these things, they're lining up, at least where we are here and now, the mid 1960s. I mean, as we move forward in a few years or so, we'll, be maybe the analog at that point will be, around the early 70s, or, maybe with where we are here and now, the early 70s is a better comparison. But so from a market point of view and the way markets are moving, the big picture trends, it's lining up with the 1960s. And I mean, that's such a huge difference. I mean, people will point to 2008 and 1929, but during those periods, bonds were in a secular bull. And what's interesting is when bonds are in a secular bull, that's when you get stock market crashes, because people, they can sell it. They say, okay, I'll put my money in bonds. They've been doing well. They're not in a secular bear. So again, the only time they were in a secular bear was 65 to 82. And if you carefully look at the cyclical bear markets in that period in stocks, they're you don't get crashes, and so they're much different compared to the other periods. But I mean, I will say there is a lot of debt now, so that is one comparison to '08 and 1929. But there's just no, other than that, there's really no similar comparison. 2008, remember, precious metals were in the middle of a secular bull. They had already been going up for 7 or 8 years versus where we are here and now. They've only been going up for a couple years. And I mean, as we're probably going to get to, which I talk about in the book, just in the last week or two, we see gold breaking out against the 60-40 portfolio, the conventional investment portfolio, and gold finally breaking out against the stock market, breaking out from a 4-year base. So those moves are setting the stage for, or confirming that a real secular bull market in precious metals is now beginning. And in the book, I talk about, we need that to happen for more, because until that happens, money is still buying stocks and conventional investments. And so now that we see that happening, what that tells us is that more capital doesn't mean every person who owns stocks is going to buy gold, but slowly more of that money is going to move into gold. And I mean, as this has happened in the past 2 weeks, we're seeing stocks really starting to move up, and the miners and some junior, they're really starting to outperform gold. So all this money is coming into the sector. And so it's a big point of why I wanted to write the book, because people in the last few years, they were saying, oh, well, why aren't miners performing, or why aren't juniors performing? And I touch on that in the book, but the biggest reason, there's 2 or 3 really big reasons, but the biggest reason is the stock market is still in a secular bull. And so when the stock market is in a secular bull, people can invest in that. They don't need gold. And even though gold was going up, people, they can just put most of their money in the stock market. Maybe they were putting a little bit into GLD, but now that gold has broken out again against the stock market in the 60-40 investment portfolio, that tells us that more money, slowly but surely and steadily, more money is going to come into precious metals and secondarily other hard assets.
Yeah, this is all really interesting. And I would ask if there's anything further you would say about gold breaking out against the stock market and against that 60-40 portfolio, because just so people understand, this is something that you talk about in the book, but it's happening right now as we speak. So anything you would add there?
Yeah, well, the gold against the 60-40, that ratio it's actually breaking out of a 10-year base. So gold, and again, the 60-40 is 60% stocks, 40% bonds. Now, we know that bonds have been a disaster the last few years. So gold has been outperforming the 60-40 for a few years, but not in an impulsive way, just a little bit. There have been kind of little moves up and sharp pullbacks. but now it's finally pulling out or breaking away from a 10-year base. And by the way, silver, I mean, I think silver just broke out from a 4-year base against the 60/40. And, silver has more room to go, but I mean, eventually in the next year or two, silver will probably break out of a 10 or 11-year base against the 60/40. But that's the significance is, when you look at this chart, going back 100 years, you can see, with respect to the moves in favor of gold, there's only been 4 since the 1920s. I mean, the first one I think was in 1930. Then you had the early 1970s, and then of course 2000. And now we're seeing it again. Like we're seeing a clear breakout in that ratio and a clear breakout in gold against the S&P 500. And so that's the important thing. Gold against the 60/40 is breaking out of a 10-year base. We know that those kinds of breakouts are really, really significant. And the second thing is this doesn't, like, you don't see these breakouts every 4 years. I mean, they're with respect to gold, they're every, quarter century, basically. So it's hugely significant, as we're saying, like we're right in it. We're right in the beginning of that move, in the very beginning of more and more capital starting to move out of stocks, to a lesser degree bonds, because that's already happened. And that's going to come into gold and gold stocks as well. And so you have all this capital coming in the market, and that it spills over. It goes from gold to the gold stocks, and then the juniors and the explorers. So the setup is there for the struggling parts of the junior mining sector to perform really well, because now a huge amount of capital is about to come in.
Okay, I'm going to definitely come back to that. But before we go there, I just want to ask about the implications of all of this for U.S. stocks. How did they look moving forward in these circumstances?
Yeah, it's a really good question, because interestingly, if you look at, so these breakouts that I was speaking about, gold against the stock market, gold against the 60/40, so these occurred in the early 1970s. But if you look at the stock market, if you look at gold stocks, and again, they functioned as gold in the 1960s. If you look at gold stocks divided by the 60/40 or the stock market, in 1965, they really started to break away from the stock market, the 60/40. And it makes sense, because the end of 1964, they began this huge breakout move. But the reason why that comparison is important is because the S&P, the secular bull in the S&P, did not end until the end of 1968. So in real terms, the stock market in the 1960s, it was basically done in the mid 60s when gold stocks made that huge breakout. But the S&P still made a higher high a couple years later. And so that's important to today, because that tells us maybe the stock market can still make a higher high in a few years. I mean, it doesn't necessarily mean it's going to do a moonshot, because the stock market high in 68 was not that much higher than the one in 65 and 66. So I'm leaving that possibility open, where maybe we go through a recession and a bear market, the market recovers and it's able to make a slightly higher high in the next 2 or 3 years potentially. So I'm leaving that possibility open. And we're just, we're not going to know whether, that's feasible. I mean, we'll need more time. I mean, if we have a real mild recession and the market only goes down, 25, 27%, something like that, then I'd say the odds of that similar new high in a few years is definitely on the table. But if this is a real nasty recession, and just policymakers in the U.S. are unable to really get out of it for a little while, then the outlook for the stock market is not as good. But if you look at that period, the mid 60s to the early 80s, I mean, you had these huge swings both ways. So what'll happen is, when the market recovers, again, depending on where we are here and now, but when the market recovers, like you're not going to see this 5 or 7 or 8 year recovery, where it's smooth and it goes straight up during that period. Like you'll see a choppy recovery where maybe it only lasts a couple years. And again, the market moves up, but maybe it makes a false new high, because the S&P, it made another false new high actually in 1974. So that's also a possibility. But that to me, for all the reasons I've already discussed, is my template, for the next 10, 15 years or so. And just another thing to mention is I'm not big into like short or medium term cycles, but you tend to get a peak in inflation every 30 years and a major inflation peak every 60 years. So every 30 years, 1920 was a peak in inflation after that pandemic. 1951, commodity prices peaked. Of course, we know 1980, 1981, huge blow off move in gold, silver, and commodities. And then 2011 was the last peak. And so that's lining up for 2040. And if you look at every 60 years, so you have the Civil War in the early 1860s, then you have 1920, which was a big peak because the peaks in 1920 held up for a really, really long time. And then, of course, 1980. So we're setting up where, looking out over the next 10 plus years, 10 to 15 years, that time is ripe for, a significant peak in inflation, which means where we are here and now, we can see a lot of inflation, of course, a lot of volatility in that over the next decade or so. And what happens during an inflation period is, stocks tend to do okay at the beginning of it, but you're at the beginning, you're in the middle, and maybe you think you're okay, but they really kill you in the last half of the period. So the psychology on inflation being bad for stocks, like that'll take some time, I think, for most people to understand. But valuations as far as stocks, we know they're really high, but during an inflationary period, that's when they come down. So that's another point to make, is that valuations over time will come down. So I know that was a really long answer, but that's my template and outlook for the next 10 to 15 years.
No, I think that's really helpful and very thorough. So thank you for taking the time to go into it. And I'll let us go over to take a look at gold stocks right now. So you essentially outlined some of the reasons why they haven't yet been moving as much as some investors would hope. So maybe we take a look at their potential in this environment and where you see, I guess, the most upside.
Well, it's almost, I wrote about this a month ago or so. It's almost a perfect setup for gold stocks, because if you look at, let's talk about the fundamentals. The best fundamental indicator for gold stocks is the inflation adjusted gold price. So gold against the CPI. So I used to think, well, this is not important. Like, who cares? Gold against the rate of inflation. But when I looked at this, I thought this looks a lot like the gold stock indices. So other than the 1960s, which was kind of a unique period, you look at the last 100 years in the Barron's Gold Mining Index, it's very similar to the trends in the inflation-adjusted gold price. So it's mirrored it really, really closely. And so the inflation-adjusted gold price right now is basically trading around the all-time high from 1980. So the inflation-adjusted gold price is really close to breaking out of a 45-year base. So that's really significant because gold stocks follow the inflation adjusted gold price. And just one reason why it's a good fit is because gold stocks, they follow their margins or their earnings or how much cash flow these mines are producing. They follow that more so than the gold price. So of course the gold price is the biggest driver, but costs are also an issue. And so the CPI, or the rate of inflation, is a really good indicator for, not the best, but it's a good enough indicator for the cost of these miners. So that's why the inflation adjusted gold price, or why the gold stocks track that really, really well. So that's, again, we have a 45-year base in the inflation adjusted gold price. So that can break out and make a really big move, which will be a huge boom for the miners moving forward. And as we know, right now, they're in really good shape. I mean, they're putting out record numbers. So this could get even better over the next 12 or 18 months, before inflation comes back, and starts to hurt the miners like it did after COVID. So that's one thing. And if you look at valuations, they've been moving up as more money is starting to come in. Valuations are moving up, but they're still historically really low. I mean, I think a couple months ago, the gold stocks were trading at about 8 times cash flow. I pieced together in my book, a lot of history. And so what I found is, dating back to the 70s, they've traded in a range from about 5 times cash flow to 24 times cash flow. But if you bring that in a little bit, most of the time it's about 6 times cash flow to 20 times cash flow. So again, a couple of months ago, they were trading at only 8 times cash flow. They're probably above 9 now. It's probably gone up a little bit, but still, the gold stocks, just based on valuation, they can move up 30 or 40%, and the valuations wouldn't be extreme. And I think that will happen anyway. So you have valuation upside. You have a chance for these margins to get even better. And then technically, you look at these indexes, they're coming out of really significant bases. GDX just broke out of a 4-year base at the end of last week. Yesterday, GOEX, which is similar to GDXJ, that broke out of a 4-year base. I know GDXJ, I think it's made a new 4-year high. So the miners are breaking out of these indices. And another one for you, I think XGD in Canada, which is the Canadian GDX, basically. So if you look at that, that's removing the impact of a strong US dollar. That broke out of a 14-year base last week. So again, we were talking about how significant, the cup and handle breakout, gold breaking out against the 60-40. Okay, the stocks they're not breaking out of 10-year bases, but they're breaking out of 4 to 5-year bases. That's still really, really significant. And what I'd say the most important thing, if you look at fund flows, into miners, like in the last year or so, they've actually been negative. So, and retail investor sentiment towards miners has been negative in the last year or so. And, another chart I have in my book, if you look at the assets that are in GLD, for example, or GDX and GDXJ, you look at the assets divided by the total ETF assets. I have these charts on my Twitter. Again, you look at all the assets in the minor ETFs divided by all the ETFs. Like a couple of months ago, that was like at a 16 or 17-year low. So yeah, that just speaks to what's been happening in the last few years where, again, all the money has been buying stocks. The majority of the money has still been going into the stock market. So you put all these things together, that's why it's a perfect setup. And I published a video yesterday, and I think you could see this year, the miners, like the sectors, they could really run hot. Like, they're probably a little overbought now, but again, they just had this huge breakout. There's barely any money in the sector. So you have this setup where they could, run hot and run overbought for most of the year because everybody in their mind, they're still waiting. Oh, I'm worried about a correction. I'm worried about the 2008 boogeyman. They're so overbought, they're going to correct because that's what happened in the last 5 or 10 years. But we're in a new paradigm. We're in a new secular bull market that has been confirmed. And I don't like to sound or want to sound like a gold cheerleader or a cheerleader for the miners and the juniors, but they're really set up where they could run really hot here for the next 12 or 18 months and just make a huge move because it's all there. The technicals are there, the fundamentals are there. And again, the sentiment, the amount of money, there's not that much in the sector. So those people, who've been shunning the sector, they're going to slowly start to buy the miners and put their money to work. And so that's going to really, I think, prevent the miners from having any long or significant corrections here over the next year or so.
Really good to go into that as well. And I think that'll be welcome news to many people in our audience. So from what you're saying, it's really clear that gains are coming for gold stocks across the board that's building right now. Do you have a preferred area of focus in terms of, majors, mid caps, juniors that you like to look at, or are you looking also all across the board?
I do look all across the board, but it's a great question because in the book, I talk about, the best area, at least that I focus, that I think investors who are new to this, which they should focus in. And that's basically companies that are building significant mines. So you have late stage developers or you have junior producers that are going to grow their production. And at the same time, those types of companies, the ones that actually put money to work, continuing to do exploration, that's a way where they can add more value in addition to growing their production. Because if we look at the Lassonde curve, for example, which I'm sure everybody's familiar with, you have that huge move down, before, as it's constructing and getting ready to build the mine. And while they're doing it, it comes down. And then you have that great buying opportunity, which, there's not a perfect, for some stocks, it might be 3 months before they produce or, 9 months or 7 months. So every case is different. But, that to me is the best time to buy these companies, right before they're about to build a mine, or maybe at the beginning of building it, and they're set to increase their production. And it's just, there's more predictability. I don't want to use the word certainty, but there's just more predictability with producers and developers that are building mines. It's easier to look at what they're doing, think about, okay, this could be the gold price, this is the margins, this is how much cash flow they might have at 2,500 gold or 2,700 gold. This is the valuation they could trade at. Okay, do they have a royalty, or how much do they dilute their stock? So it's easy to look at those things and calculate what the potential upside could be in various gold and silver price environments. And again, at the same time, those companies that are still keen on exploration and pouring lots of money back into exploration, those are the ones you want to own, because we know that exploration can drive lots of value. And so I really, looking at producers who do exploration, developers who do exploration, I think that's a real area where you can find hidden gems. I'm not opposed to looking at explorers and lots of those types of companies, but they're just more difficult. Like there's way more uncertainty. Like I don't want to gamble on drill holes. I know that might sound insulting, to some explorers, but you really need to be an expert if you're looking at that, or you need to follow someone you really trust who is an expert, at looking at those explorers. And the difficult thing is, you kind of have to take a shotgun approach there, where everybody wants to find the next Founders Metals, or the next Snowline Gold, or the next Great Bear, but to find those types of like you need to invest in 3 or 5 or 7. Like you need to buy a basket of the explorers, because it's just so difficult to know which of the ones is going to make that big discovery, and and have the stock that ends up going to 25 or 30 bucks, like Great Bear did. So I'm not opposed to looking to those types of exploration companies, but again, I like to focus more on the developers and producers. I've had the most success there, and I think people who don't have a lot of expertise, they should stick with developers and junior producers, companies that are cash flowing and earning money. And again, there's a final point. Those types of companies, they're really leveraged to the move in metals prices, versus exploration companies. The exploration companies who have less, I would say less than like 2 or 2.5 million ounces, they are not leveraged to metals prices. Now, if they make a big discovery, then they will be leveraged to metals prices. But if you're looking at a very early stage company, explorer, maybe it only has 1 million ounces or 700,000, or it's a silver stock that has, they have 40 or 50 million ounces, they're more leveraged to making a discovery and growing their resource significantly. So they're more leveraged at that point to exploration than the actual bull market and metals prices. So that's a distinction that I think we should make, because people just assume, okay, gold and silver going up, it's a bull market, let me just pick anything that's 5 or 10 cents, and this could go to $1. I don't think that's a smart way to do it. I think you can, go for something like a developer or producer that's more high probability and still get a really, really good return. But yeah, again, the smaller exploration companies that don't have 2 or 3 million ounces, or 100 million ounces of silver, unless they have something like that, they're not leveraged to metals prices. It's all about exploration success at that point.
Yeah, I think that's important to make that distinction and understand what's going on there. I've got, I think, one more point I wanted to ask you about in terms of the gold stocks, because you mentioned in your book, if we're going into this long-term secular gold bull market, it doesn't mean that gold stocks are outperforming gold the whole time. There can be fluctuations in terms of what we see there. So I just wanted to make sure we touch on that a little bit, if you had any thoughts.
Yeah, I have quite a few thoughts on that, so I'll try and be as succinct as I can. I talk about in the book a big issue that nobody mentions. Why the gold stocks? Well, there's 2 issues why they've really struggled. Number one, you had a secular bear market from 2011 to 2023. So you're in a secular bear market. Valuations get worse, or depending on your perspective, they get better, but they get lower. If you're trading at 10 or 11 times cash flow in a bull, you can trade at 7 or 8x in a bear. So that hurt the companies, which nobody mentions. The second thing is, the introduction of the gold ETFs, because we were talking about before the 1960s, there was no way to buy gold. But if you think about it, it was really, really hard to buy gold until the ETFs in 04, 05. And so what did people do who wanted gold exposure before the ETFs? They bought the big gold stocks. So the gold stocks traded at much higher valuations in the 80s and 90s, even though it was a secular bear for the entire industry, because anybody who wanted gold exposure, they had to buy the large gold companies. And so the introduction of gold ETFs and silver ETFs as well in the mid 2000s, that diluted the buying power into miners. It introduced this huge competition in the form of gold and silver ETFs. So that hurt the stocks significantly. And again, I mean, there's a few people who've mentioned that here and there, but it's, rarely is that mentioned. So these are structural reasons. You hear all these things like, oh, well, there's political problems, there's, bad management, and it's true, but these are the structural issues. You had huge changes in the ETFs, which really hurt the miners, and you had this secular bear market from 2011 to 2023. So we're coming out of that, and it's, talking about the miners versus gold, they tend to outperform in sweet spots. Like the miners will outperform gold when you're coming off like a really oversold crash type low. So after 2008, for example, after the COVID low, those are just two examples. The other point is usually after a gold breakout or a silver breakout, you will see that outperformance. Now, we did have the breakout in gold, a major breakout, of course, a year ago, and it's taken some time for the miners to really outperform gold, but we are gaining some traction right now. And so they will tend to outperform in like bits and spurts. Like I think they'll outperform in like various 2 or 3 year periods. And I think we're in one of those periods. And the reason is, again, if you think about the inflation adjusted gold price and you think about where we are economically, the breakout in the gold price, or I should say the breakout in the inflation adjusted gold price, the potential for that to really run, that's going to be really good for the miners, because if you think about the price moving from 3,000 to 4,000, if that happens in the next 12 or 18 months, we are not going to see a lot of cost inflation during that period because of economic weakness. Yes, of course, there will be some cost inflation, but it's not there right now. So the gold price, metals prices are going up faster than costs. But what'll happen is if we're 12 or 18 or maybe 24 months from now, maybe if metals prices keep moving up, but inflation at that point cost inflation can be going up faster than metals prices. And so that's when you won't get, any leverage, and the stocks will not outperform the metals. So I mean, there's no like one simple strong answer, but I would just say, I think we're in a real sweet spot right now where I think over the next 12 or 18 months, is a period where, you could see the entire sector really outperform the metals prices. But, stepping back, if you're a real serious investor, it's really best to build your own portfolio, pick the best companies, become a stock picker, because this is a sector where there's huge variance in performance in a lot of these companies. So I would say build your own, if you like the juniors, build your own GDXJ. If you can pick the best companies and you're a good stock picker, you will outperform the sector, and you can still find lots of companies that will leverage gains in the metals prices much better than the sector as a whole. So you have to be a stock picker.
Okay. I think that's also really good context for people to be aware of. And I want to make sure to ask you about silver as well. But before we go there, we should also touch on gold and price expectations or price potential in this long-term run that you see coming.
Yeah, I mean, the long-term potential, it sounds really ridiculous, but if you look at major peaks in the last 100 to 150 years, gold against the S&P, I mean, 4 or 5x, 7x in 1980, but if that's not unreasonable. So like a 4x or a 5x for gold against the stock market, that would be, what does that put us? That puts us close to like 25,000 or 30,000 in some cases. And if you look at the monetary base of the U.S. and you look at the reserves that the U.S. has, basically the gold price went to a level in 1934 and 1980 and some periods in between where the gold price and the amount of gold, or I should say the gold price was high enough where it backed 100% of the monetary base. So for that to happen again, I think we're looking at 23,000 or something like that. I mean, if that were to happen today. So if we're looking out 10, 12 years from now, yeah, I mean, there's really insane potential where the gold price could go. And talking about silver, again, if you look at the last 100 to 150 years, there's 3 or 4 times, I think, when the gold silver ratio has come down under 20, to 15x or 16x. So if you think, okay, gold based on these numbers can go to 25, 30,000, that means silver is going to go to 1,000. It's going to go to 4 digits. Now, a couple important things. That doesn't mean the price will stay there, because you'll get a crash at the end. So that's what we're looking at, 10, 12 years, 15 years. It could be, something around those levels. But zooming in with where we are here and now, I do think that this particular cyclical move, I mean, it's hard to guess at this point, but I would say, we could have, depending on how fast it goes up, we could have another 2 or 3 years left in this cyclical move. And I tend to think gold could get to 7 or 8,000, which, I mean, it sounds really extreme, and silver could go well over 100, maybe to 150 in that type of case. It sounds really extreme, but after this cyclical move, like, we will have a crash in the sector similar to the mid 70s or 2008. So even though, the more accelerated the move, the higher the prices go in the next, 2, 3, 4 years, that will set up for a cyclical bear market, which, will look like a crash. Because after every bull market, the miners, they have 65% declines. Like, if you look at the period from 1957 to 1980, I think they had at least 2 65% declines, maybe 3. I mean, it would be 3 if you count the one after the peak in 1980. So again, we're in a real sweet spot here where there could be an incredible bull market over the next 3, 4, maybe 5 years, but I think it's going to be closer to 3 or 4 years. So there's going to be huge gains coming, but it will end with a crash before the next leg gets going, or maybe not a crash, but just a severe bear market.
Yeah, okay, so we got a kind of a 2-in-1 there with the price potential for both gold and silver, and I do appreciate you saying what happens after all of this price activity pans out. That's always good to remember. I wanted to talk a little bit more about silver. I know you talk in your book about it's got its precious side and it tends to follow gold. There's also the industrial side for silver that we have to be aware of and pay attention to. So any thoughts you would add there? Could that potentially weigh on silver moving forward?
Yeah, my opinion has changed a little bit since the last time we did an interview, but generally I still believe what I wrote in the book, which is silver is a leveraged play on gold. So the industrial side of silver really has no impact on the price right now. It's basically all gold. But what's interesting is that I think in the last year, this may have been the first year ever for silver, like, we saw big increases in investment demand, in industrial demand at the same time. So that's interesting. But again, the number 1, 2, and 3 driver for silver is the gold price. It's a leverage play on gold. The industrial side really doesn't matter. Maybe the industrial side will help support the market better in a downturn. But I do think it's interesting. I mean, did I say that because maybe in 10 years, like, there's a chance, if the industrial demand keeps running and it keeps steady over the next decade and the price keeps moving up, like, you can see a repeat of the late 70s or 1980 where someone might try and corner the market. Just because, again, with where we are here and now, if you have investment demand increasing and you have industrial demand increasing at the same time, like, that's something that we have not seen in recent decades or recent years with respect to silver. So industrial demand, not really my expertise and forte, but when I talk to people about that and I look at some data, that could play more of a role in later years of this bull market. But again, I would say here and now, it's all the gold price that's a driver for silver.
Yeah, I think good to get your thoughts there and have some clarity. We've covered really a lot of ground, I think, in terms of gold stocks, silver. I don't want to keep you too long, but before I let you go, I would ask if there's any final thoughts that you would want investors to be aware of, keeping in mind that, as you said, all of this is happening right now.
Yeah, I would say, well, first they can get a free copy of my book if they go to thedailygold.com/book, a free PDF and EPUB file where it's all there. So get a free copy of my book. I would say, one thing for investors, they need to follow someone, that they trust or who's giving them really good information on these companies. And I would say, the macro and all these predictions are really interesting. And, at times there's some important analysis behind it, which I try and use, but you are going to make the most money picking the right companies. So I would say for investors out there, spend your time really researching the companies and learning the companies and becoming an expert on the companies. You're not going to make money, predicting macro or trying to, predict tops and bottoms and sell out. Now, in my premium newsletter, I'm a buy and holder. I don't trade, but I do mention I might take a few profits when breadth indicators get really, really extreme to the upside. So there is some science behind that. But again, stepping back, we will make the most money by picking the right companies, picking the leaders. And that's why we should spend most of our time researching and analyzing companies, listening to company interviews that are on your channel and other channels. That's going to help you make way more money than trying to listen to all these macro predictions. I know they're really entertaining and it's important to listen to them in some cases, but some of the best investors of all time, they just focus more on the companies. They don't really focus that much. Yeah, they might have a macro view, but they're not trying to predict every little turn in the economy or the macro situation. Again, focus most of your time and research on picking the best companies. That will suit you well. You will make the most money and keep the most money in this bull market.
Okay, I think that's really good advice to end with. I definitely get caught up in all of the macro ideas and things, and it's so easy to get lost in all of that. But definitely, it's a time for focus now. And I will add a link in the video description for the book so that people can download it. And yeah, thank you very much for coming on to go over all of these different topics. This is really useful.
Oh, my pleasure. Thank you so much for having me.
Of course. And once again, I'm Charlotte McLeod with investinnews.com, and this is Jordan Roy-Byrne with The Daily Gold.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.